Hey Tribe, Sean here. Welcome to Next Level Tribe Tuesday, where together we will play the finance game and also learn how to invest together. Now, let's talk about the finance game because this is the first portion of the workshop. It is a two-portion one. We'll talk about the finance game first, where we have a financial makeover. Make sure that our personal finance is strong before we even talk about investing. These are 12 mini workshops, and this is the third series. In the first series, we talk about the money slavery. Are we slave to money? Okay, are we making choices because of money? And we talk about the solution, which is to govern money, meaning to say we learn how to manage money and not let money manage us. So we learn how to generate, govern, grow, and also give the 4Gs. And we also talk about the roadmap. This is a very, I would say, powerful roadmap, which is taking reference from a lot of other roadmaps that's already created. It's not totally my idea, but I take reference from Dave Ramsey and a lot of other, I would say, experts have gotten through this kind of particular roadmap. You can design your own. And we want to talk about a very important principle first. First of all, don't be too worried about money. Reason is, well, Sean, you're not being realistic. Money is such a big worry. Now, the reason is this: the money doesn't belong to us. It all belongs to God. And God gives us the money. He gives us the resources, the ability to make money. Well, now ask Him for more ability and also cast the worries back to Him. This is from reference 1 Peter 5:7. Now, you must understand something. We cannot take away anything when we leave this earth. And the journey in this earth, we do not know how unpredictable it is. I heard of many sad stories recently, even celebrities or very young people just being taken away from this earth. I shouldn't say taken away, maybe going back to God, correct? So why worry about something that doesn't matter in the long run? However, we are still asked to be faithful steward. We are supposed to be, I would say, good managers of the money. So lesson 1, transfer the deed back to God. Lesson 2, we also talk about the 5 financial ratios to have a assessment. So it's important to assess our health. Now, in lesson 3, I want to talk about something that is pretty serious, and more younger Singaporeans, I'm not sure how young is young, maybe like below 100 years old is young. Okay, but anyway, a lot of Singaporeans are getting into debt. That's terrible. Now, not just Singaporeans, Malaysians, and everywhere in the world, everyone is getting into debt. This is because of a certain culture, consumerism, buying a lot of things, and also people are getting a little bit smarter. They think they are smarter. However, let me share with you, some of the corporates or some of the financial institutes are even smarter than you. Let me share with you some issues about getting the debt. First, taking reference from, again, the biblical wisdom. That's the most important portion. There's many ideas on how you should actually use debt to grow your money. There are certain ideas of you should just spend as much as you want and then grow your ability. Some people say you should live below your means, but what is the correct thing? The correct thing is, number 1, do not desire to be rich. Just desire to live your potential, to generate, I would say, more value to the society, and the richness will come after you. Your desire should be to provide value. Okay, by the way, when I say all this, right, doesn't mean I'm preaching and also like doing this. Okay, I also need to be reminded, just to share with you guys, I'm far from being perfect. Well, a lot of times people who say this, they will be doubly judged, right? So I hesitate to actually share all this, but I just felt that there was an opportunity, and it's my obligation to point us back to the truth. Okay, so don't aim to be rich, aim to provide value, aim to do God's word. The rest will come. Okay, everything else will be provided. Seek first the kingdom. Okay, the second portion is this. Now, this doesn't say that there's nothing wrong borrowing money. There's nothing wrong. But the thing is this: once you borrow money, you become a slave. The borrower is a slave to the lender. Is that true? Think about it. How much hard work are you putting in every month to make money, and how much of the money is to pay someone else? Okay, so if let's say you're working for someone else for many months or years, aren't you a slave? Now, the third thing is this: the plans of the diligent lead to abundance. Okay, but everyone who is hasty comes only to poverty. Now, why do I say this? Why do I talk about desiring to be rich and also being hasty? It's because the main sources of debt, right? There's a few things that really caught my eye, and I also experienced it myself. I went through the mistakes myself. Okay, now house loans, I don't think it's a big mistake, especially if let's say you're living in Singapore. There's no choice, you gotta get a house loan. So that one not that bad, but most of the sources of debt comes from maybe education loan, credit card debt, personal loans, car loans, gambling, and investing debt. Now, this is something that I want to touch on. As an investor myself, I used to have a unrealistic fantasy that I have become very good in investing. I can make 20%, 30%, 100%. Okay, every single year. Or some people can make 30% per month. Okay. Well, we experienced that before, haven't we? And because of that, right, some people say, I'm going to take a personal loan. I'm just going to take a loan of maybe 100,000, 200,000, pay 10%. But using that loan, I can actually make 20%. So I'm using other people's money to make even more money. By the way, if it sounds like you, I'm not talking about you. I'm talking about myself. I did that in the past. I did that in the past and it was terrible. I become slave. I become slave to the loan company that I borrow money from. And you know what? What's the worst thing? There's no guarantee in investing. The worst is sometimes when you are in investing that you're borrowing money to invest, the pressure becomes higher. You make more investing mistakes. So if you're already in that situation, please stop digging, stop borrowing more money. Okay. And I want to share with you guys that there's ways to get rid of the debt. Get rid of the debt first and separate your investment account. These are two different things. And if you're in debt, you're in a horrible situation, you're losing a lot of, I would say, money every single month just by paying off debt, maybe you're not in the right situation to invest right now. Stop investing. Just go and learn how to make more money and really pay off the debt. This is my own opinion. Okay. And by the way, not financial advice, it's just my own opinion. Please do your own homework. Okay. So now I want to give you a hypothetical example and I want to share with you two strategies we can adopt to get rid of our debt as fast as possible. When I talk about fast, we have all different ideas of what it means to be fast. Let's look at some mathematical calculation. These are examples that is based on real life situation, but it may not be totally accurate because there are different terms and conditions for every different loans. But here we have Davon. Davon owns about $100,000, not including house loans. I'm taking away house loans. So he owns like 40,000 in car, 10,000 in education because he took his parents' CPF to pay for his education and now he has to pay back at 2.5%. Personal loan, he took this money, $20,000. And he thought that he could invest well. So he took $20,000, paid 8%, and aimed to make 20%. However, it's not going too well for him. Sometimes make, sometimes lose, getting very stressed. And he's also have a credit card advance. He bought certain maybe holiday packages. He bought certain items that he want for his house renovation. And now it's growing at 26%. How should he get rid of it? First of all, let's take a look at the minimum monthly payment. I want to share with you that when we talk about minimum monthly payment, in case you didn't know, this is the payment that you pay so that you don't get penalty. They don't make you like pay extra. However, this minimum monthly payment is not enough to pay off the loan. Meaning to say, if you just pay this minimum, this amount, this $100,000 will grow. It will grow. Very likely, this amount of minimum payment is only to pay the interest, okay, and probably not even hitting the principal amount, which is the amount that you owe. So do not just pay the minimum. You got to pay it off as fast as possible. And you can see that the minimum monthly payment is already around 2,000, 1,950. So let me show you two strategies that we can adopt. Number one, we call it the avalanche method. The avalanche method use the whole entire mountain to wipe off the whole entire debt, okay, as fast as possible. And we also have the snowball method. The difference is this, okay? The avalanche method pays off the debt with the highest interest rate first. So let's look at the avalanche method. If you look at my screen, we have arranged the debt in terms of the highest interest to the lowest. Okay, credit card being the highest, 26%, followed by personal 8%, all the way down to education loan. The whole idea is this: for the rest of the loan, okay, loan 2, 3, and 4, item 2, 3, 4, we're going to pay the minimum. We let them grow as slow as possible or stop growing. Think about it. Education loan, well, I'm only paying 2.5%. I'm going to drag it out. I'm going to actually let it grow slowly. Okay, pay $250 a month. Make sure I'm not going to pay it off. Okay, it's just that this is not my focus. Only when I have money next time, then I pay it off. Since it's growing slower, 2.5, I'm going to get rid of the credit card loan first at 26%. So with $2,500 a month, where is he getting that $2,500 from? Very likely from bulk of his salary. He should really learn how to actually like do side hustles, maybe go and get a Grab, I don't know, a weekend Grab, a part-time job or things like that. Really make money to get rid of all this, okay? So you can see 2005, he's going to pay off the minimum, okay? $700, $600, $250. He's left with $950. He's going to conquer and attack. We call it attack the credit card bill first. Okay, the credit card bill, you're not going to pay the minimum. Okay, you're going to pay the actual payment. Sometimes the credit card bill will ask you to pay $1,000, correct? But you're just going to pay whatever you can. Okay, it may be below the monthly payment. It may take a longer time, but however, you spend the bulk of the money. You can see there's monthly payment here, there's a minimum. I'm just working out some sums for more realism, but you can see it. If you just pay the monthly payment, altogether, it may cost you 3,000, and you may not even have enough money to pay $3,000 worth. You can only pay 2,500. So how do you spread it? Pay the minimum, and the first one, the first line item, you attack with all you can. Okay, but make sure that these other three loans don't grow. Now, the snowball method, we arrange it differently. We arrange it from the smallest amount first. Education is the smallest amount, 10,000, followed by personal, 20,000, credit card, 30,000, and the car loan is 40,000. It's regardless of the interest. Okay, so same thing, we pay the minimum on the rest and we attack the smallest amount first. Now, which one makes better sense? Let's take a look. Now, so this is a very quick calculation. Let me just highlight to you some things. So for the avalanche method, you can see we attack the highest interest first, the credit card. So we conquer the credit card bill first, okay? And it takes us about 32 months to get rid of it. And after that, we go for the personal loan, then the car loan, then the education loan. It will take about 50 months, okay? It will take about 50 months to finish paying this using the avalanche method. For snowball method, we conquer the education loan first, okay? It takes about 13 months. And then after that, the whole entire thing, because the credit card loan, the rest of the highest interest rate ones are still growing, it takes longer, about 54 months. So let's put this into perspective in a table form. Now the strategy, again, avalanche, pay off highest interest first, snowball, pay off smallest amount first. The months to complete, avalanche about 50 months, snowball 54 months. So what's the total amount we paid? 50 months multiplied by 2005, assuming that we don't really have an increase in salary, we don't have more amount to pay off. If you have, do use your money to pay it off first. Don't go and book another holiday session. Pay off your debt first. Well, actually, you should go for some holidays. Take a break. Don't be really like a slave, correct? You're not in a prison. You are just like, you have the obligation to pay off. Okay, so, well, I take back my words. You should go for small holidays, not expensive ones. Just to enjoy yourself. Now, where else for snowball method? Because you pay 54 months, you are paying a lot more. Okay, when I say a lot more, it's about $10,000 more. And you're taking a longer time, you're paying 135,000 instead of 125,000. Again, if you have more money, pay off faster, you can actually save more money. Okay, the amount of interest paid, 25,000 in avalanche, and the snowball method is 35. So the obvious winner, okay, for the strategy is avalanche method, right? Now, I want to share with you something shocking to me. When I say shocking, on hindsight, maybe not so. The success rates, okay, the success rate cited by research, okay, by universities, by Dave Ramsey, by personal finance experts who survey more than 10,000 people. Okay, using the avalanche method, the success rate is less than 50%. Meaning to say people who use the avalanche method, half of them continue to be in debt. Whereas the snowball method, more than 80% of them become successful. Well, this is not verified. It is a lot by citation. But I saw a lot of banks, a lot of financial institutes, they cited that the snowball method is better. Now, is it because they want to earn more interest from you? Maybe that's why the banks ask you, use the snowball method instead of the avalanche. Use snowball, you pay us more interest. Okay, maybe that's the case, but let's be a bit more open-minded. The whole key idea of why snowball method seems to be more successful is because of this thing called motivation. Now, let me explain to you. The months we take to complete the first debt. Remember, avalanche method, we are paying off the credit card debt first, but the credit card debt is a little bit bigger, okay? So it takes us 32 months. 32 months is more than 2 years, okay? Whereas the snowball method, about 13 months, 1 year, 1 month, we finish paying off the first debt, which is the education loan. Now, why the snowball method is cited to be more successful is because if it takes you too long to see results, you get discouraged and then you go back into bad habits. Maybe it's just like exercising, okay, or maybe like going on a diet. If I'm going to tell you, you're going to run 10K every month, 10K every day, you're going to eat like very healthy, but it takes you 2 years before you see your first weight loss. It takes you 2 years before you see like loss of 1 kg. Wouldn't you? Okay, but maybe I say after 2 years later, you will not see any loss, you will not see any results, but 2 years later, boom, your six pack comes out. Okay, so but you have to wait 2 years. So after doing it for 1 month, 2 months, 3 months, about 1 year later, you're thinking, is this really working? I don't see any results. I'm still in debt. I'm still in case of weight loss, I still don't see any results from my body. I'm still overweight. It becomes very demoralizing. Whereas for snowball method, it's maybe like I'll give you some diet plan, and within the first 1 or 2 weeks, you start to see some results. Well, I don't get my six pack yet. I'm not like totally ripped and healthy or like totally the ideal body, but I see small results, and that's why I continue to go on. So, well, the comparison says that snowball method is a better idea, and it makes sense. It makes sense. Now, why do I say it makes sense? Now, logically, avalanche method makes more logical sense. However, if you are already someone logical, you wouldn't get into debt in the first place. You do not have the rights to assume that you're a logical person, unfortunately. If you're in huge debt, don't ever think that you are too smart. You are so smart to be able to use a smart method to pay it off. Very likely we are not that smart, okay? So, by the way, when I talk about you, I'm a lot of times talking about myself because I went through all this myself before. Well, thank God I never go into like debt so bad that well, this stresses me out here and there, but got paid off very fast. Well, snowball method, right? We see small successes. Okay. So now, logic that fails. I want to share with you a few things. Number one, do not try to use high return investment to cover the loan. That will not do. It is a gamble. Okay. Don't do that. Don't think that, okay, I'm going to actually like take whatever amount of money I have left, go and invest so that I can cover my loan. Dude, if you are Warren Buffett, maybe you can do that. But Warren Buffett will not get himself into such a situation, correct? So I can tell you, you're not in the financial or nor the mental situation to deal with this. You can't do that. Investments needs a lot of, I would say, mental fortitude. Second portion, don't try to borrow more money to cover the loan. Now, but Sean, if I can actually borrow money at a lower interest rate, like 5%, 10% to cover the loan, I should do that. Logically, it makes sense. But let me share with you, very likely you fall into this loan because you have lousy calculation or you don't read the fine prints. Okay, so now I'm gonna like reserve this open because later maybe I'm gonna advise you to go and ask a debt counselor to take a look at it. Okay, so this is terrible. Try to borrow to buy time. So you borrow money from someone, from loan shark, to try to buy time. This is terrible. You're actually selling away more time. You're taking a lot more time to like pay back your loan. So what do you do? What you do now is really look at your whole entire financial situation, and maybe some of the suggestion is go and get a debt counselor. So there are lots of debt counselor all over the world. Go and speak to them. There's nothing worse than doing this yourself, correct? So go and speak to them and then go and ask them for help. And it's okay. There's nothing to be ashamed of. You can bounce back and you can become a success story to share with the rest. How you were initially in debt, you almost went bankrupt, and now you are a successful financial steward. Okay. And this is something that I guess will be pleasing, correct? Okay, so you can go and take a look at, for example, ccs.org.sg or look for debt8.sg if you're in Singapore. If you're not in Singapore, just go and search for debt counselor and the country. Okay, I have nothing against England. Please don't slam me for this. I mean, you can slam me if you want, but I'm just using an example. Okay, so any country, just type debt counselor and then your country, and you will be able to seek help. So really go and seek help. Go and get clarity. Go and get a peace of mind. There's no point living every single day with such stress. Is your ego that important? Your ego is worth nothing. A lot of people, probably we get into a lot of debt. Maybe you spend a lot of money on things that is for your own self-fulfillment and ego. It is worth nothing. No one cares about how good you look, and no one envies you for what you're showing them. Okay, for a peace of mind, for a family, go and seek help. So again, come back to God's word. Again, the borrower is a slave to the lender. We know that. So what we need to do is we need to be diligent. The plans of the diligent. They didn't say the plan of the rich or the plan of the whatever situation you have. So even if let's say you're in debt right now, if you have a plan and you diligently work on the plan and work hard on it, you will be abundant. Okay, so this is something that is very, very important. Don't be hasty to try to pay off your debt. Don't do that. Don't try to use funny, smart method to pay off debt. Doesn't happen. Okay. So I do hope that this helps. Not a very popular, I would say, message, but I do pray that those of you guys who are in debt right now, or you know someone in debt, share with them this video. Give them some encouragement. I've seen a lot of, I would say, friends who were in debt and are still in debt right now because they have quick ways. And maybe it's my fault because I lent them money and I never really, I would say, expect them to pay me back. Maybe I spoiled them. I should like let them go through their own like situation, correct? And maybe one day you can become like Devon. Devon is a secret name for debt vanished. Okay, I don't know whether it's lame or not. But well, Devon, the example, it can happen to us, okay? And one day we can also eliminate all of that and let all of them vanish, okay? So this is the first part of the financial makeover workshop. And today we talk about debt management and elimination. Next week, we'll talk about time value compounding and also how to avoid the get rich quick trap. So I hope you have enjoyed yourself. If you did, comment below, subscribe, give a like, and also tell me what other financial issues you have you're facing or you know of people facing. Again, I'm not a total expert. I study this together. I would love to like explore this together. Maybe you see me getting into some of this trouble, and maybe I will need you to remind me of some things that I've talked about. Okay, so great. Now the next part, let's go to Investing University. If you need a break, just pause the video and come back. Otherwise, we are going to dive straight into Investing University, where we talk about how to grow our wealth in a fundamental, solid way. When I talk about fundamental, I'm not talking about just fundamental analysis, but really fundamentally the techniques used in investing. Disclaimer, I'm not a licensed financial advisor. This is not financial advice. I'm not recommending you to buy or sell anything. Please really do your own homework or seek the advice of a financial advisor whom you know actually knows what is happening. So test the financial advisor. Not all financial advisors, I mean, they're qualified in terms of license, but in terms of knowledge, I've seen terrible ones. So they are not all made equal. If you're a financial advisor, please, I mean, I think you agree with me that not everyone is equal, correct? You are the good one if you're listening to this. Okay. Anyway, homework one, we talk about setting up your brokerage account, and we talk about having your shopping list, companies that you want to buy. And homework two, we talk about reviewing income statements of the companies you want to invest in. Today, let's talk about the balance sheet. Now, this is a very, very powerful, I would say, like a financial statement. And why is that so? You'll understand that in a moment's time. So now balance sheet is amazing, you know. You know why? Because when we choose to buy a share of a company, example I used was Walmart. So I'm going to continue this example. Walmart, if you're buying Walmart, you need to know what you're buying. Example, let's say you want to buy my company. You want to buy Next Level. And you come over, you got to check what you're buying, right? I remember watching a Taiwanese show. That's so funny. It's really funny because, right, this particular company, they wanted to buy over another company. So the, okay, let's call them A and B. A wanted to buy over the company of B, and A is a tyrant. A is someone super rich. She wants to bully B, and then B, he owns a small little company in this nice little building, and they are really, I can't remember what the business was about. So when A actually spent the money to buy over the company of B, right, he signed the documents and he said, okay, you're going to hand over your company to me on this date. So on that particular date, A went into the B company's office and say, now get out of this office because I own your company. And B laughed at him and said, oh, what do you mean by that? This office is a rented office that I rent from someone, and now the rent has lease. The rent has changed to a new company, which is my new company. The old company has stopped the lease already. So you get out of this office. So A was in a shock. He said, you mean I didn't buy over this office? You mean I just buy over a company that's just renting an office? and B actually laughing off. So it's important to know what you're buying when you buy over a company. I don't know whether you all watched that Taiwanese show. If you did, tell me the title of it. I can't remember what is it. Okay. Anyway, come back to here. Let's talk about Walmart. When we talk about Walmart, when we want to buy a share of Walmart, we want to know what we are buying. In case you don't know what Walmart is, it's a super big supermarket. They use the word super twice in a sentence. My teacher is going to feel very sad, my English teacher. Okay, but anyway, when we talk about balance sheet, you look at the balancing scale. On one side is all the assets, okay? And on the other side, it is the liabilities and the equities. Now, this is how I like to look at it. Now, Walmart is a super big supermarket. It's a supermarket, okay? And this supermarket, right, they have assets to run their business. So every day they sell goods and services, right? Not services per se. Okay, they sell goods like Coca-Cola, they sell your groceries, they sell bicycles. So I think of the biggest supermarket, you times it 1.5 times is probably like Walmart, or maybe it is Walmart you're thinking of. So now for Walmart, they have assets, they have cash. Okay, it's a bit small. Later I'll go into details. Okay, you have cash, you have inventories. Inventories is like all your groceries and things like that. You have all this. You have property. Okay, for example, your supermarket, you need a property. You have long-term assets and quite a number of these things. Now all these are things that you need to run your business. Does it make sense? You need to have cash to run your business. You need to have inventory to run your business. So all this allows you to run your business. If you want to set up a Walmart, you likely need assets like inventory. You need cash. You may not need it at this scale, like they have a $9 billion worth of cash. maybe if you want to start a small little mart, okay, but you do need cash. You didn't do need all this. Now, these assets to run the business are financed. Okay, how do they actually get the money to actually pay for all the like inventories and pay for the property? It's either financed through equity. Equity means, hey, be my partner, come and join me as an investor. Okay, so people who invest into the company, or they are financed by liabilities, which is loans. Loans is example, they can actually go to Coca-Cola and say, can I take like 1 million bottles of Coca-Cola first and pay you later? So it's like taking a loan. They borrow the Coca-Cola, okay, or they buy the Coca-Cola and they will pay the Coca-Cola later. But it's a liability. They can also go and get a bank loan, okay, like a long-term debt, financing loan, or even when they buy their property, there's a certain loan. Okay, so this is a liabilities that is like a loan. Investors is like capital equity. So when you add up the amount of liabilities plus equity, this gives you enough money. Here, 252 billion, 252 billion to finance your assets. Okay, so this is why it's called a balance sheet. Assets equals to liability plus equity, because you need liabilities and equities to finance your asset. So this is how I look at it. If you are a professional accountant, you think I'm wrong, feel free to comment below and I would love to hear your perspective. Okay, so this from an investor's perspective. Now, let's take a look at the line item. So by the way, first of all, how do we find out where's the balance sheet? Okay, this is what they call a balance sheet, but where do we find the balance sheet? So let me bring you to Google and you can search for Walmart. How do I search for this? Walmart balance sheet or Walmart financial statement, annual reports. Click on this, they will have financial reports, annual reports for you. Click on the annual report, you can go into the PDF file, search for balance sheet. So you can see that's where I get the assets, I get the liabilities, I get the equities. I mean, I don't get it, but I see a snapshot. So first thing first, they say as of January 31st. This is January 31st, 2025. Okay, I think it should be 2025. Okay, because it's the latest balance sheet. So it is a snapshot because you must understand every day the cash comes in and comes out. People are still paid every second right now. People are spending money at Walmart. So this cash is like, okay, pause for a moment. Let me calculate them. It is that one split second. So everything changes. But as of now, you can see what is the amount of cash you have. It's a rough gauge. It's a rough gauge. Okay, so it's very important not just to look at now. Okay, as 31st January or it's 2024. Okay, you can compare to the previous years to see whether from last year until now is there a growth in terms of cash and cash equivalent and so on. Okay, I'll be explaining some of these key items here. This is the way to find the balance sheet. Now, another way to look at it is from Jita. So in jita.com, you can sign up for a free account. You can search for Walmart. This is what we did last week. And we have seen Walmart's income statement. So Jita is a free website. It gives you a consolidated 10 years results. So you click on financial. Okay, 5 years result actually. But we can look at the 10 years summary later. And once you're in the financial, click on balance sheet and then click on annual. So you can see for the past 5 years, how is the situation of Walmart growing? Is their assets increasing? Are their assets increasing? Is their assets? Okay, never mind. Sorry, my English teacher. Okay, so anyway, coming back to here, 2020, you can see they have cash of 9 billion. How do I know billion? Because here is in millions of USD except for per share item. So 9,000 million is 9 billion, 17 billion, 14 billion, 8 billion, 9 billion. So this is the amount of cash. Now, is this a concern? Later we will dive a little bit deeper into it because sometimes they use the cash for certain things or certain period in time, they have more cash for certain reasons. So now this is what we have, the list items. You can look at it on Jita or you can look at it in the balance sheet. Jita is pretty good because I can see 5 years straight as compared to only 2 years in the, I would say the annual statement. Okay, so the annual reports. Now, let me share with you the line item very quickly. In fact, the slides, I put all this in. I will put the slides into the Telegram group. You can go and take a look at it. You can take a reference for it, okay? So first we talk about assets. Now, assets are things that they need to run their business and things that they own. So these are also things that, example, you have assets like car, you have assets like a house. All these are yours that you can actually sell to make money or to bring in money, right? So example, they can sell away all this and this will be the total cash they have, total assets, $252 billion. Okay, if they sell everything. So their bank will have $252 billion. And later we talk about it, they have to actually pay off their liabilities, pay off all their loan, their bank loan, how much they own Coca-Cola. And this is the total liabilities. 252 billion. Minus away this is how much the total equity has. Total equity, 90 billion, belongs to shareholders. Okay, so when it belongs to shareholders, that means that if let's say the company is to dissolve means that if they sell away everything, okay, we're not going to run Walmart anymore. I'm tired of it. I'm going to sell away everything that I have, sell away all my inventory, sell away all my property. I'm going to pay off all my liabilities, pay off all my suppliers, pay off all the bank loan. I'm going to return all the money to shareholders. This is the amount of money that they will be paying us back. Got it? This is the amount of money. Okay. So now let me share with you some key things. So in asset, let's take a look at asset. Okay, it's super interesting. What are we buying when we buy Walmart? So we are buying a company with this asset. An asset is divided into two portions. We can see current asset and long-term asset. So current asset and long-term asset. What's the difference between current and long-term? So current assets are assets that you can liquefy. Did I use the correct word? So turn into cash. You can actually sort of turn them into cash within 12 months. Okay, so what you can see example, property is not under current asset, it's under long-term asset. Hey, but Sean, I'm good at selling property. I can sell them within 2 weeks. Well, I understand that. Some of you are very good property investors and also maybe property agent, but I'm talking about on a accounting basis. Okay, property is typically not something that you take and use as a cash. Okay, so these are things that will be liquid or used up within 12 months. So some of them short-term investments, okay, things that like stocks, bonds, trading assets, again, they actively buy and sell to make a profit. So let's see. Interestingly, Walmart, okay, they do not have really short-term investment or trading assets. You can see that. They don't have this. Cash and cash equivalent. These are money that is in their bank or in their cashier. So it can be even fixed D. Why do they say cash and cash equivalent? So maybe fixed deposit. Well, it's not really something you can access immediately, but if you want to, within 12 months, within 3 months, you can access them very quickly. Okay, so these are assets. So accounts receivable are things that people owe you. They owe you money. They have to pay you. So you can see example of accounts receivable, customers that own the company for products and services. Hey, wait a minute. You see, like, how come? Because people go to the supermarket, they pay immediately. Why do they owe money? Well, you must understand Walmart has this thing called a Walmart credit card. I think with credit one company, I'm not sure whether it's still ongoing, but there are customers who still have not fully paid yet. Okay, so you can see accounts receivable about 8 billion. Oh, there's a lot, man. Okay, so well, we talked about credit just now, right? About people owning credit card debt. So this is what's happening. Now, next portion, inventory. Inventory is basically their groceries, their eggs, their chicken, their like bicycle, things that they put into their store. They are holding that $54 billion. Okay, prepaid expenses. Again, I have it all here. Hang on a minute. Prepaid expenses are expenses that they have already paid for. Example, rental. Maybe they pay rental 3 months in advance, and these are about 3 billion worth. So total current assets, okay, things that will be used within 1 year. You can see even prepaid expenses, like I pay for my rental 3 months in advance. Well, I'm going to use it within the next 3 months. So you can see all these are within 12 months. So if you buy Walmart, you're buying a company with all these assets. People still own them, about 8 billion. They have 9 billion in cash. They have inventory of 54 billion. In case the company closed down, you buy over the whole company, you can eat 54 billion worth of groceries. But I don't know the perishable. Some of them may just be expired within the next few weeks, right? Okay, but you get the idea. You get the idea. You have this, a company that owns all this. Now, let's look at the non-current assets, long-term assets, or sometimes they call it non-current assets. So non-current, long-term assets, they are liquid from a period for more than 12 months. You will not use them within the next 12 months. So let's take a look at what they are. Number one, property, quite simple. Okay, here, plants, property, machineries. So these are basically things that, well, if you go into the building of Walmart, likely they own that building. They own $239 billion worth of property, plant, and equipment. What equipment do they have? Maybe the cashier, maybe, I don't know, the shopping cart. So every time you steal a shopping cart from Walmart, you do not pay it back. Well, you're making the shareholders poorer. Okay, you get the idea, correct? Now, there's also accumulated depreciation. Now, what this means is, right, they have bought like all the shopping carts, they have bought all the cashiers, but they also know that these shopping carts will not last forever, right? Maybe this shopping cart, they can last for 5 years. So let's say they buy $100 billion worth of shopping cart. They will say, well, if it lasts for 5 years, every year, let's set aside 20 billion. We have bought 100 billion worth of it. Let's set aside 20 billion of expenses or cash to save out, to plan next 5 years later, we're going to buy more of them. So this is called depreciation, which is an expense something that they actually set aside a certain amount of money. They say, okay, the asset, well, when we bought it, it's worth 200 and over billion, but right now, over the years, it has gone down in value. So we're going to depreciate it. So again, this is to be very, I would say, accurate, because like I told you, assets are things that we can sell away and turn into cash. But however, my machineries, my buildings and all that, maybe the current market value is no longer worth 200 billion. It's only worth, let's say, 130 billion. Well, a lot of times this is also understated. There's a particular accounting principles that say that if it's an asset, if it's something that belongs to you, make your balance sheet looks good, you could put at a lower amount. So this likely is understated, because like we know that building, although, well, let's say they bought it for tens of billions, over the years it may even increase in price. But usually most companies, they do not reevaluate their companies. Typically they don't, okay, or their buildings, okay, but some of them do, so you're going to be aware of that. But right now you can see depreciation, it is 130 billion worth of current market value worth of their property, plant and equipment. I hope this helps, okay? So now, next portion, long-term investments, maybe fixed D, more than 3 years, treasury bills. Okay, goodwill. This goodwill is very interesting. It can be maybe even their branding, their connections with their customers, connections with their suppliers. All these are things that they assess to be things that you can't really measure. Now, another possibility of goodwill, when you see 28 billion, wow, there's a lot, man. What is it? It may be something that they actually buy. Okay, they buy another company. Example, they buy a petrol station. And that petrol station, okay, let me try to explain this. So goodwill. Let's see, where is it? So when we talk about goodwill, right? So example, when they actually buy a petrol station, and that petrol station, we should see quite often, correct? Like Walmart petrol station, if you are in US, petrol station is worth, let's say, $1 million. However, when they negotiate with the owner, they say, I want to buy it over, and the owner say, I'll sell it at 5 million. So when they actually buy a petrol station that is worth 1 million based on market value at 5 million, why would they actually pay 5 million? Because in their opinion, they say, well, market value based on their assets, based on their liabilities is worth 1 million. However, we think they can make us a lot more money, so we are willing to pay 5 million. You can see that this 5 million they pay for something that's worth 1 million, there's a $4 million in assets. So they paid an additional 4 million. They consider this goodwill. So goodwill means things that can't really be quantified. So we pay this additional 4 million. It is an asset to us. We believe that it will give us even more money. So in this 28 billion, there will be some of the acquisition that they bought that's above market value. Okay. So this is the idea of it. So other intangibles. Other intangibles, as mentioned, just now we talk about goodwill. Intangibles are patents, trademark, brand names, even database and things like that. So these are intangibles. So these are things that the accountants will actually go ahead and calculate a certain amount of it. Now, the next portion, we talk about loans. Well, loans receivable. So they lend people money. They don't lend people money. Okay. Accounts receivable long term, no. Nobody own them a lot of money for long term. Deferred tax. Okay. So deferred tax means that these are tax credits that they can actually get back the credits. So these are things that it is a asset to them. So when you buy this company over, assuming that you buy over the whole entire Walmart in probably a 1 year time, 2 year time, 3 years time, there will be $1 billion worth of tax credit coming back into your company. Oh, that's cool, right? Okay, other long-term assets. Okay, these are things like, example, is there any examples of long-term asset? Okay, yeah, like here you can see they own that doesn't fall into previous category. Okay, now you have things like expenses paid for, or they are basically not goodwill, they are not intangibles, they are not plants and properties. What are other long-term assets? Probably maybe some other things that they bought. Okay, so you can see total assets. Okay, but all these can be turned into cash. 2.8 billion worth of it. So total assets, 252 billion. So there we have it. We are buying a company with all these assets that is financed by liabilities, okay, and also equities. So let's quickly take a look at liabilities. Okay, we need to know when we buy this company, what are we owing? Okay, we own these companies, but what do we owe people, correct? So liabilities, same thing. There's current liabilities, things that we need to pay within 12 months. Okay, so some of the current liabilities, accounts payable, means that money that the company owes suppliers. Let's see how much they owe. Current liabilities. Oops. Okay. So current liabilities here. Okay, accounts payable, they owe 56 billion. Dude, when you buy Walmart, you suddenly owe someone 56 billion. Okay, again, don't have to be too worried. Let's take a look at the cash. Come on, man, the cash is not enough. Okay, so you can see these are the things to take note of. Very likely you can see the inventory is 54 billion, correct? The inventory is 54 billion, which is all the groceries, Like I mentioned, all the Coca-Cola, I'm using Coca-Cola excessively, all the Mr. Beast Feastables, chocolates and stuff like that. It is very likely financial. Okay, we should have to pay out in a few months' time because this one, current liabilities is less than 12 months. So we have accrued expenses, things that, again, they have to actually pay for it, okay, within the next few months. They are using it right now, maybe, I don't know, electric bill or things like that, okay? Short-term borrowings, current portion of long-term debt. Okay, so again, you can see that there's long-term debt. Maybe they borrow money from bank, and this bank say you have to pay over 10 years. And for this portion, what they have to pay right now is here, current portion of long-term debt, current portion of capital leases, tax payables. All these are things that they have to pay right now, okay, within the next 12 months. So I've actually given a breakdown here, all the, I would say, definitions of it. Go and read through it. And if you need to find out more, feel free to ask in the Telegram group or simply just go and ask ChatGPT, okay? This is what I do actually when I prepare for this. Not everything I could understand. I'm not trained in accounts. Actually, I am in business school, okay? I'm trained, but not to that extent. But you get the idea. We continuously ask. So these are the current liabilities. So they have to pay within 12 months, and the long-term liabilities. All in all, in short, they owe $161 billion. Okay, they have assets of 252 billion. They owe 161 billion. So this is the amount that shareholders have. And it's broken down into like a few portions, like treasury stocks. They don't really have treasury stocks. Treasury stocks, sometimes they do shares buyback and they keep the shares, okay? Retained earnings. Okay, this is very important. Retained earnings means the profit that Walmart made this year, okay? They made this year and they do not pay out in dividends. This is the amount of money they make. They don't pay out in dividends. It becomes part of our equities, which is our net worth, okay? Remember when we go back to the first slide, or we talk about whatever assets that we have, including the cash is becoming more and more because we are making more and more money. All these are assets. We have to pay back all the liabilities. So the remaining is our net worth or equities. So these retained earnings add up to our net worth. Every year you make more money, your net worth increase. If you start to lose money, your net worth decrease. So retained earnings, very, very important aspects of it. And we can see total equity, it is this amount. Now, we do have to actually take away, okay, or account for this thing called minority interest. So what this means is, example, the example I gave just now is we bought a petrol station, but we didn't buy 100% of the petrol station. We bought maybe 80% of the petrol station. 20% still belongs to that shareholder. So we need to account for the fact that when we count the whole entire revenue, or let's say the whole worth of the petrol station, 20% doesn't belong to us. So we got to do some accounting to make sure that it is accurate. Okay, so these are the key things of the balance sheet. Now, I will share with you why balance sheet is so important. Okay, even equity, we talk about all these things. Now, why is balance sheet so important? It's because balance sheet helps us make very strong, I would say, valuation cases. So let me give you some example. There's this gentleman, Kin Wai. He invested in an undervalued Hong Kong company using conservative net asset valuation. Now, what is this CNAV? Conservative, conservative net. Okay, I always thought that CNAV is current net asset valuation. Okay, but he called it conservative net asset valuation, and he make 44%. And you can see that applying, okay, net current and NCAV, okay, which is net current asset value. All these methods, right, has been proven to be very successful. Let me give you some key examples, okay? So the whole key example of using all these valuation method, right, works like this. So we can see after we have this total equity, another term for total equity is book value, okay? Tangible book value, and also book value. So you can see all these, right, you look at book value per share. When you look at book value per share, right, again, what is book value? Book value is the money that belongs to shareholders. So in case the company goes bust, okay, not say goes bust, but liquidate, they have to sell away all their assets, pay back all their liabilities, and remaining amount they pay back to the shareholders. So in short, if they pay back to the shareholders, how much are they paying back? You can use book value per share as an example, okay, as a benchmark, which will be about $10.41. So if let's say you own one share of Walmart and Walmart closes down, after selling away everything, they pay back everything, they will give us back about $10. Don't forget, there are some portions that's called goodwill. Okay, how are you going to pay that back to us? Well, maybe goodwill, they can also monetize, they can sell it off. But that one, yes and no. So another more conservative way is to look at tangible book value per share. So we are going to get back about $6. This should be quite accurate. Another more conservative method, they look at only current assets. Okay, they take current assets and see how much money they get back, because properties may take a long time. So this is a valuation method. If let's say the company right now goes fast, I can get back about $6. Now let me give you another example, okay, of let's say Citigroup. Okay, Citigroup. Okay, we go to the balance sheet, we go to the annual amount, and we look here. Now you can see that for Citigroup, the tangible book value, okay, or rather, the book value per share is $101, and the tangible book value per share is $89. Now remember these two numbers, because what I'm going to show is this Citigroup stock price. Right now, you can buy Citigroup at $79.61. Hey, think about it, okay? If Citigroup closes down right now, you are likely to get back about $89. Okay? Well, if let's say they're able to monetize their goodwill and intangibles, you can get back $101. But right now, you're only paying $79. That's $10 below the tangible book value. And you guess what? The bank, most of their asset is in cash. So is this a strong idea for valuation? Well, obviously, that's if Citibank closes down. Now, and one thing that we like to take a look at is, right, we also like to really strongly like to focus on this thing when I look at this valuation method, which is whether their book value is growing. Because if their book value is not growing, then it's not a good idea, because they are losing money every year. Then you may not want to invest in this company. So example for Citibank, okay, now you're looking from left to right, 2016 all the way to 2023. Book value per share from $74 to 70 all the way to $98. So you can see the book value is growing pretty steadily. The price now is $79. Okay, so good idea, correct? I mean, good idea in terms of valuation. Again, not a recommendation to buy or sell. And I will share a few that this method, right, has been proven for many, many years and proven by a lot of research, a lot of fund houses. So this is a study done by Tweeny Brownie. Did I pronounce it correctly? Okay. But the key thing is this: you can read this paper. Is what has worked in investing by Brownie and Tweedy Brownie. Okay. If I pronounce wrongly, please pardon me. And I want to share with you some of the key ideas. So they have done research where they take all the S&P 500 companies. They break them down into different percentiles, okay? So some companies, they have 30 to 0% of their book value. Okay, so what it means is the price. The price, example, if let's say the book value per share, okay? Every single share, the book value is $100, okay? Is it similar to Citigroup? I remember Citigroup was about $100, correct? So let me explain to you this again. So if let's say you take a look at the balance sheet, assuming, let's say they found a company, the book value per share is $100, okay, around 100. Right now, imagine you can buy it at $30. Okay, so that's what it means in this study where they say 30% of the book value. So you can buy $30, 30% of the book value. Okay, you can buy, let's say, 40 to 30%, 50. So they group these stocks into the price to book value. So if the price is 30% of the book value is here, if it's 40% of the book value is here, up to 100%, 120, 140. Anything above that, they are not considering. So they took all these stocks and they invest into this basket of stocks. Every stock that's 30 to 0% of book value, we'll buy it and consider this category. Now, if you buy companies with, let's say, 100% of book value, so example, Citibank right now, it is $100 plus, and you can buy the stocks at about, it should be around this range, right? 100 to 80. Take a look at it. Over the years, 1 year, 2 years, 3 years, compared to S&P 500, S&P 500 make about 8.5%. In 2 years, they make about average is about 18%. In 3 years, they make 27%. If you just invest in companies with about 100% to 80% of book value, you make 15%, which is a lot more than S&P, 34%, and also 51%. Okay, so look at this. If you can buy them at really cheap, really low book value, like 30% of book value, right? You can see that the average returns. Okay, with a high book value, it's about 48%, all the way increasing to about 88%. And you can buy at net current asset value, 66% of net current asset value, which is a Benjamin Graham method, which I'll touch on subsequently in valuation methods. Okay, 66% of it, you can make 87% of returns, average returns. Isn't that pretty good? So this is pretty proven, and it is done years from 1970 to 1981. And they have done even other research like unleveraged companies. Meaning you say companies, you can read here, where their debt to equity is below 20%. So I mean, when it's above 20% debt to equity, it is considered leverage. Now, if you don't understand what's debt to equity, don't worry. I'll be covering this during some of the financial key statements, key financial ratios that we look at when we actually study into companies. So unleveraged companies, very interesting. You can see 30% of the book value is 100 over percent. Over 5 years. Okay, no, over 3 years. This is over 3 years. This is over, 3 years. So you can see that this is a very proven method. And do read this article. I'll put the link inside the Telegram as well. And this is very, very interesting. It's very exciting for me because you are buying into a company that is undervalued and it's pretty safe. And remember, if you are buying a company that has increasing income, they are making money year on year, their book value will increase and you can buy below the book value. Well, think about it. That's for you to decide. Okay, it's not a financial advice. So I do hope that this has helped you. In conclusion, balance sheet. It's beautiful. It's one of the beautiful financial statements I like to look at. I mean, I love looking at income statement. Balance sheet. Wow. Completes the picture. Okay, I shouldn't say complete because there's still cash flow statement. Otherwise, you guys won't come next week. Okay. Anyway, it gives us a snapshot in time of what we are actually buying in terms of assets and liabilities, and it's essential for valuation in value investing. So, what's your homework? Your homework is to study the balance sheet of the companies you want to own, and also you can ask questions in the Telegram. So, how do you study the balance sheet? Go to jita.com, or you can go to the financial statements of the company and go and study them, go and look through them, go and see what you're buying. Now, again, one thing I want to add, in relation, all these numbers are very big. Wow, 22 billion, 100 over billion. Again, look at it as a trend. Has it been growing? So that's why I like to look at example, where's this Citigroup. Let's look at Walmart again. So in Walmart, all in all, after looking through the balance sheet, I like to go to fact sheet. Okay, fact sheet gives you 10-year results. Example, book value per share. So you can see book value per share of Walmart from $8 growing all the way to $10. It is pretty slow though. Every year is growing by 1-2%, as compared to Citigroup. Well, they are growing a little bit faster. So I do hope this helps you guys. Hope that you have improved yourself in terms of your knowledge in investing university. I'll see you guys next week. Remember, after doing all this, you got to be diligent. The plans of the diligent leads to profits, leads to abundance. And also remember, sizing is everything. Position size, make sure you diversify your risk and make sure that you really keep safe. And remember, money is not everything. Money is just part of the resources to help us reach our goal and to be a good steward. I'll see you guys next week.